Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Certainly the news of the day from a company perspective is Intel. We saw early this morning, we saw a pretty cool story. Nvidia deciding to buy or invest $5 billion into Intel vis-a-vis a stock purchase, a straight-up purchase of common stock there. And that's alongside the earlier investment by the U.S. government of a 10% stake in Intel, and the stock reacting favorably here today. Shares of Intel up about 26% today. That sets a new 52-week high. Stock's up 57% year to date. This stock was really hurting as recently as 6 months ago, but boy, it's gotten a couple big shots in the arm as it relates to their AI outlook. Let's check in with Mandeep Singh. He's a senior tech analyst for Bloomberg Intelligence. Mandeep, how surprised were you in Silicon Valley when we woke up this morning and saw that a competitor was going to make a $5 billion investment?
Yeah, I was expecting something to happen in terms of an investment in Intel after the administration took a 10% stake, but an investment from Nvidia, that was the last thing that I anticipated. So I was more in the camp that one of the hyperscalers, whether it's, and Amazon did have a partnership with Intel. It was announced back in 2024. So I thought it would be one of the hyperscalers that would make an investment. So clearly the surprise element was the fact that the partnership or the investment wasn't for foundry, but it was more chip co-design. And look, that's where Nvidia has taken share from Intel over the past 2 years. Right. Intel was a dominant force in data centers with their x86 architecture. Nvidia, with the shift to AI, really took share from Intel. And so it is a big surprise, the fact that they are investing $5 billion. And the plan is to develop a co-designed chip for PCs as well as data centers,
and to help them better compete against AMD, which we see a little under pressure today.
To my mind, Nvidia is almost a monopoly in AI chips. So the fact
look out, antitrust regulators.
Yeah,
but when I heard about this deal, I just thought irony, right? This tie-up between two Silicon Valley rivals. But I think it also really underlines the power shift. When you think about it, you would have thought years ago, well, Intel would be the aggressor here, right? But the sort of the tables have turned.
They have, and look, that's just a function of where Intel is at right now, both in terms of their foundry positioning as well as, the data center market share that they have lost. Where they still have a dominant share is in PCs and desktops. And that's where everyone was anticipating a big refresh cycle because of AI. At the end of the day, if AI was to become pervasive, we'll have to upgrade our devices, whether it's PCs or smartphones. And to my mind, Intel does have a good chance of being part of that refresh cycle. So what Nvidia has done is really kind of put a stake in that refresh cycle, where if they can develop a co-designed chip for the PCs and laptops, then that's where it could create another line of business similar to gaming. So right now, gaming is about a high single-digit percentage of Nvidia's revenue. Well, this could be another line of business that they could add if this partnership was to result in a product or a chip that everyone would want to use.
All right, Mandeep, I'm going to put my cynical Wall Street hat on. This is simply
I agree
a political move by Jensen Huang to cozy up to the Trump administration by co-investing alongside the U.S. government in Intel, whether it's a good investment or not.
Yeah, $5 billion is like change for a company like Nvidia that's almost generating $100 billion in free cash flow every year right now.
So the clients you talk to, the investors you talk to, they think there is some soft upside to Nvidia by investing alongside the government here?
I mean, Nvidia right now is taking stakes in a lot of companies, CoreWeave and a lot of neoclouds, because they want to make big bets. With that kind of balance sheet that Nvidia has, they can afford to do it. And so this is another one of those minority stakes that they took. I don't think they have any high expectations here, but still it does help them politically.
I mean, these are the numbers that blow me away with the tech companies that Mandeep Singh that follows. This year, call it, the calendar year 25, fiscal year 2026, $100 billion of free cash flow. Next year, $140 billion of free cash flow.
Free cash
This
flow.
is the stuff, like, literally, we don't know what to do with it. So we're either going to give it back to shareholders,
right?
We're going to, I don't know, or we're going to make
buybacks,
or we make
yes.
investments
Right.
in. So there you go.
But Paul was talking earlier about how he thinks the pie is big enough, right, for all these players, and that not to worry too much about AMD. Is this tie-up a threat to them, do you think?
It is if they come up with a product. So if they come up with a chip that can drive a PC refresh cycle, it's going to hurt AMD. But look, these design wins take time to result in a product. And strategically, yeah, they will develop something. That's why I go back to what Amazon and Intel did a year back. Did anything change after that? No.
Good point. Is there anybody out there that maybe AMD now should start to cozy up to?
Probably one of the hyperscalers, because the hyperscalers are doing a lot of their custom chips. And if AMD is part of that ecosystem, that certainly will help drive up their orders. So I expect them to partner with one of the hyperscalers.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Want to talk supply chain now. And who better to do that with than Gene Seroka, CEO of the busiest port in the U.S., the Port of Los Angeles. And guess what? He's here on the East Coast, right here in our New York studios. So, Gene, thanks so much for joining us. We
Great to
appreciate
see
it.
you, Alexis.
Great to see you. I know the LA port handles a lot of international cargo, especially from Asia. I know that trade volumes in August were near all-time records. Here we are, mid-September. Where do things stand now?
It's been a roller coaster of a year. When hard trade policy comes out, you see a real slowdown in cargo flows. Then when that policy is softened and deadlines extended, cargo picks up for that window of opportunity. And that's what we've seen. But July and August combined are our busiest 2 months in the 117-year history of the port. Wow. Folks are bringing in inventory before the next policy statement may come out, trying to protect themselves for the all-important year-end holiday season for retailers, and the parts for American factories are keeping a lower but very steady flow.
So, Gene, a lot of people are unsure how tariffs work, but the reality is, I believe they occur at your port. The actual collection of the tariff occurs on your turf, right?
That's right, Paul. And a cargo container cannot leave the port without that tariff being paid by the importer of record to U.S. Customs.
So there's a customs office at your port, and what they do is collect whatever tariffs may be on any particular good. And that's how that happens all the time, I guess.
That's exactly right. And LA is the largest customs district in the nation. Director Africa Bell runs that shop for U.S. Customs, and her rank and file members are working around the clock, just trying to keep up with what the tariffs are, how to apply them to the shipments, and keep the commerce moving.
It's got to be really confusing for them because I just feel like the needle moves constantly. How many companies, though, are really able to pull forward their inventory? Are you still seeing that in a big way as we move closer to the holiday shopping season?
Yeah, Alexis, here's the interesting fact. You've got about 125,000 companies that call Los Angeles home to import their goods over the course of a year. No one company has more than a 5% share. So we're made up mainly of small to middle-sized businesses, some of whom are telling me now they're dipping into savings to pay these tariffs.
So is our customs office, are they in fact keeping up with the collection of tariffs on all these additional goods? I mean, do they have the manpower to do it all? Do they have the facilities to do it all, the technology to do it all?
They truly have risen to the occasion, Paul, and doing a great job. I look at those vital statistics of the port through the Port Optimizer every morning, a 90-second flash report. Our numbers on velocity are better than they were before COVID.
Wow. You know, I think we all saw those dramatic photos of the cargo falling off in Long Beach, not your port, but at the port of Long Beach. I think it highlights also what a dangerous job this can be for those workers. But I'm just curious, did that have any impact, knockoff effect on your port?
That's right, Alexis. You know, the first thing is, thank goodness no one got hurt. The men and women of the International Longshore and Warehouse Union are on the ground moving all this cargo, and thankfully no one was in harm's way. The investigation will continue. I was talking to some folks last night at a big industry event back in Long Beach, and they haven't been able to get their cargo out yet. So the U.S. Coast Guard, National Transportation Safety Board are going to take a deep look at this, see what the causals are and how we can make sure it doesn't get repeated again. But effectively, that particular terminal in the Port of Long Beach is an investigation site. So shipping lines are having to maneuver around that as best they can, but no real slowdowns because of it.
Amazing.
So the economic data seem to suggest that in terms of tariffs, the question is who pays for it. We know that it gets collected at your port by the U.S. Customs Office. And then it's a question from that perspective, how much gets passed along down the line to the wholesaler, to the distributor, to the retailer, and then ultimately to the consumer. What's from your view at the port? Do you have any understanding how that's happening, how that's playing out?
Yeah, Paul, three real areas that importers have been focusing on. Can I go back to my manufacturer and negotiate a little bit on the price and see if we can mitigate? Some mixed effect there. Do I just absorb it and try to find efficiencies in my own company? We've seen the results from the big auto companies in Detroit. That hasn't gone well either. Mary Barra announcing big tariff hits on cost. Same thing with Jim Farley over at Ford. And then others are saying that they're trying to pass on to their customers if they're in the factory business, manufacturing, or to consumers. And we have seen that as well. So it's just kind of a spread across those three categories. And I think we'll start seeing even more of that hit towards the fourth quarter of this year.
I know that in just a few weeks, if it holds, we're supposed to be collecting tariffs on Chinese ships that call at ports, at U.S. ports. I know that President Trump's going to be speaking with Xi Jinping in a phone call tomorrow.
Yeah.
So, how do you guys at the port sort of prepare for something like this?
This is another cost that probably will be passed on as well, according to the shipping lines, to their importers. So right now, early days, the new penalty fee goes into place on October 14th. It'll be phased up. But right now, we are estimating that it could be anywhere from about $125 to over $300 per container. The shipping line will pass that to the importer of record on these fees. About 30% of all vessels that call Los Angeles today are built or managed from China. There's going to have to be some movement around this. Some companies may try to absorb. Others will shift different vessels into the rotation to avoid this penalty as a whole.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
It's been a busy day for the restaurant companies reporting earnings. We had Cracker Barrel, we had Darden earnings. We check in with our expert on the restaurant business because not only is it a view just kind of what's happening out there in the restaurant business, but I always view the restaurant companies as a pretty good gauge of how people are feeling, consumers are feeling, and how they're spending their money. Michael Halen joins us, Senior Restaurant and Food Service Analyst for Bloomberg Intelligence. Hey, Mike, let's start with maybe some good stuff. Darden, what's going on with our friends at Darden?
Yeah, Darden, it was an interesting quarter. Sales were fantastic, but slightly below, very high expectations. And the most interesting part of their report was that their margins contracted. Largely due to beef costs and Uber fees, because they did this 1 million free delivery promotions supported by Uber Eats marketing dollars, right? And so it actually made up 5% of sales, and that's very impressive for something that's been instituted, within a year. So the margins. This company has best in class margins. They've always protected their margins. And so seeing a same store sales gain a very strong same store sales gain without the margin expansion, I think shocked some investors today.
So what are they planning to do to widen those margins? I heard the portions might not be as big. Are they looking at possibly raising prices on the menu?
Well, they're going to raise prices, but not too aggressively. So they're very careful about increasing their prices. A big reason why we think they're outperforming is that they've increased their prices a lot less than competitors since the pandemic, right? And so they don't want to lose that advantage. So they are going to raise prices this year, but it's going to be modest and less than peers. You mentioned the smaller entrees. That's really a move to boost traffic. So what they're doing is they're taking 7 of their popular entrees. They're making an additional lighter menu with those 7 items. They're shrinking the portion and they're lowering the price. And they're hoping that actually brings in greater traffic with low income consumers. So shrinking the size of the entrees isn't a major plan in terms of saving the margins. With the margins, it's going to be, executing. Right. That's what they're known for, consistently becoming more productive in their restaurants. That's how they're going to try to fund this. There will be some slight price increases. And they mentioned they could be a little bit more aggressive if, the higher beef prices remain stubborn.
All right, let's move on to my favorite, Cracker Barrel. They're still paying the price for some of that rebranding issues. What's going on there?
Yeah, that one. Oh man, it's the timing of everything that happened to them is such a shame because they recorded a great quarter. Same store sales were up 5.4% in the restaurants, a couple hundred basis points ahead of the street. But sales have decelerated pretty significantly here. Since August 19th and the logo controversy. So. The stock is down a little bit today. It opened much lower. We think the call was a good one. I thought Julie Massino did a great job in the call. I don't think there was any panic in her voice. I think she's running a steady ship right now. And they're focusing on the things that they've been focused on from the beginning, which is providing better service and higher quality food at a good price point. I would say it seems like they may have sandbag guidance as well. I think that's a big part of the reason why the stock's not down more, right? Is that they basically are extrapolating current traffic trends throughout the rest of the quarter. When second measure data that Bloomberg owns that we follow is showing that traffic may be stabilizing here over last week. So I guess we'll see.
Yeah, the latest CPI report showed that food away from home, so at restaurants, actually outpaced what we're paying for food at the supermarket. But if you look at these 2 reports from Cracker Barrel and Darden Restaurants, are people eating out less, or is that really not holding true when you look at the numbers?
They both reported 5. Olive Garden was over 5%, Longhorn's over 5%, Cracker Barrel's over 5%. A lot of these stories about the death of the consumer, I think, are overstated. We've been saying it all year. Restaurant sales are going to continue to be better than they were last year. Second half's going to be better than first half. It's not an issue. To me, the bigger issue is what we heard out of Darden. It's inflation, right? The Fed just cut rates in an inflationary period, right? While we're seeing inflation go up, while we're seeing CPI and PPI go up, right? And so beef prices are stubbornly high. I look across my Bloomberg monitor and commodity prices are up across the board today, and they've been up for basically this whole year. So, I think through year-end, margins are going to be the bigger concern for restaurants.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.